The U.S. debt problem is reaching a breaking point in 2026. Treasury interest payments on the national debt surged to $92 billion per month in the final quarter of 2025. That is up 13% from the same period last year. This is according to the Congressional Budget Office. Now, for the full fiscal year ending September 2025, the government spent $1.22 trillion on interest loans driven by a growing debt load of $38.4 trillion, higher long-term interest rates, and persistent inflation. Short-term rate cuts provided only limited relief, while analysts expect borrowing costs to remain elevated in 2026. The United States is borrowing roughly $7 billion per day, with the fiscal deficit projected to approach $2 trillion this year. The primary deficit, including interest payments, stands at 3.78% of GDP, an unsustainable trajectory. With limited political will on either side of the aisle to curb spending, experts warn that rising public debt could increase financing costs for households and businesses and potentially crowd out private investment. Well, alongside government borrowing, the rise of non-bank financial institutions now hold 50% of global financial assets. That is reshaping the U.S. debt market. Highly leveraged, lightly regulated entities are taking on short-term positions in Treasury securities, increasing financial risks. Experts caution that unchecked growth in non-bank speculation combined with high public debt poses a threat to market stability, making careful oversight and prudent regulation critical.